So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Simon Castillo. Simon is a real estate investor and business development executive from San Antonio, Texas. Simon began investing in real estate in 2004 and is currently invested in more than 22 million of single-family and multifamily assets. Simon's experience includes providing safe, stable returns for investors, real estate development, value-add investing, and investing for long-term cash flow. Simon is the principal and founder of SAS Texas Capital, a real estate firm focused on raising capital for the acquisition of value-add Class B and C multifamily properties. Simon, welcome to the show.
Hey, Jonathan, I really appreciate the opportunity to come on your show. And again, great job on getting your podcast up and running. And I've been listening to your episodes and love the content so far and great value. So hopefully I can bring some value to your listeners here today.
Thank you so much. That really does mean so much to me. It was definitely a process getting it going, but I'm grateful for my team that I have because I wouldn't be able to do it without them. So, and I'm really glad you enjoy the content because that's the most important thing, but that really comes to the guests. So I know you'll provide a lot of value just from the intro. I know there's going to be some good stuff in here. So like we do with all of our guests, let's start at the very beginning. Did you kind of start in the corporate world? How did you find real estate investing?
Yeah. So similar to many other investors' stories, I started in the corporate world. My finance, my background is in finance. And early on, my thought was, I didn't buy into the whole, get rich, quick type of schemes, but I knew I wanted to do something else, and I wanted to be more of an entrepreneur. And for me, real estate was kind of a logical way into that world of entrepreneurship and building wealth. So I started buying single family homes, and that was kind of the first step. And I did that, been doing that on and off for, the past 17 years. And it wasn't until about 2 years ago where I really started to ramp up and trying to figure out how do I scale my investment activity to get to the point where I really can make a lot of things optional, like work. Like if anything happened to my corporate job, what's going to happen? I want to be able to have that option where I'll be okay. And the way that I found I could do that was scaling up to multifamily properties. And, that led me to investing passively in some syndications, apartment syndications, especially here locally in San Antonio. And then from the contacts, learning and networking, I managed to get into a general partnership role on a couple of deals, and been scaling ever since. So that kind of brings me up to where I'm at now.
Awesome. I love that. Yeah, definitely the classic hurdle there, which is scalability. Really, honestly, probably the number one reason people go from kind of the residential single family. It sounds like you still have some single family though. So you started in 04, 08. Was that hard for you? Were you set up nicely with your portfolio that you made it through?
Yeah, that's a great question because, I was fortunate during the 08, 09 period, during the Great Recession. I was fortunate that what I held at that point was cash flowing rentals. So the cash flow that properties were producing stabilized the investment during that period of time, and I was able to come through fine. The investors that I saw that got really hammered during that time were ones that were, what I call speculating. They were buying properties with the hope of, inflating their value quickly and then turning around and selling them. Those are the ones that got caught, holding onto their properties, and then they couldn't sell. And unfortunately, those are the ones that really got hammered during that time. I was fortunate, and that's to this day, that's why I'm a big believer in cash flow. If you're investing, you got to have cash flow, because that's what gets you through, ups and downs in the markets, and gets you through uncertain, economic times.
Gosh, that's the truth. And we were talking a lot about, the current economic outlook and things, and we'll definitely touch more on that. But okay, so you started single family, still have some single family, so it sounds like those are doing well for you. What was it about being a limited partner that got you, kind of looking at the general partner side of things?
Yeah. It's funny, but the power of real estate comes from relationships. It really does. I believe, I don't really believe that I'm in a real estate business. I believe like I'm in the building relationship business. And during the time that I was investigating multifamily and getting into syndications, I was going to meetups, I was networking, I was trying to meet different people who could give me these different perspectives. And I remember during one meetup, the gentleman next to me, stands up and announces himself to the group and says, "Hey, I just closed on a 200 unit multifamily property." And I'm sitting there, I'm looking at him, and I'm like, how's this guy, doing 200 units, and I'm just trying to buy one. What's he doing that I'm not? So from that perspective is what really got me interested in education. I ended up having a conversation with him. He introduced me to a couple other people. I started listening to podcasts, read some books. And that's what eventually got me into my first passive deal. And I remember when I met the general partner on that deal, I met him for lunch. I was so excited to get into that deal. Like, I was ready to write him a check right there and then. Like, how can I get into this deal today? Like, I want to make sure I'm in. Like, I don't want to miss out on this deal. And the people I met were just so, they were so accommodating, like answered all my questions. That's the beauty to me of real estate, is that you meet so many people that are willing to help others, kind of bring them along and get them to where they are. And that's really what helped me go from a passive investor to a general partner, was meeting those kinds of people, developing those kinds of relationships, and then getting me to a point where I actually now more than willing to help other people that are back where I was a couple of years ago or even longer.
Isn't it so fascinating? I don't know that I've ever seen, not that I've been involved in too many industries. I will say I was a stockbroker. I can tell you, and you can speak about finance as well. That's definitely not an industry where they want to help you. So it's so fascinating that this industry is so accepting, right? Because ultimately, in a sense, we are kind of competing against each other. But what's so great about it is that even a well-established operator versus another well-established operator can end up being partners. And sometimes that happens. And that's what's so great, is that, yeah, sure, we might be fighting for the same deals, but we could actually end up partnering together.
Yeah, that's a really great point. And I think part of it is just that the fact that the real estate is such a team game. It's so difficult for one person to do everything on their own. So you have to build those relationships. Even if you're a single family investor, I mean, you got to have relationships with brokers, realtors. You got to have relationships with lenders, title agents. I mean, there's in every transaction, there's 5 or 6 key people that are part of that transaction. And that relationships are just so important, regardless of the type of investment you're looking at. But it gets even more important when you get into multifamily, because that's where you really have, teams of 4 or 5 people that are trying to take down, a $20 million property.
Yeah, it's so true. And for anyone listening who's new or wanting to get into this, start meeting people. That's the best thing you can do. The best advice I can give is find someone who's doing exactly what you want to do and reach out. Everyone's always willing to help, which I love about this industry. Mentorships, all that stuff is great. So we were talking offline about the current state of the economy and how asset prices are getting scary. You even mentioned how you're seeing some sub 3 cap in San Antonio. But you also mentioned you're looking at some other things. So what are some markets you're looking at, and even some different asset classes?
Yeah, so we're always trying to bring value to our investors, and right now Texas is a very competitive market. We've seen San Antonio be as competitive as Dallas, Houston, and Austin. So for us, we've expanded our research. We're looking to other markets. We're looking into Florida, some of the Midwest, Indianapolis, Kansas City. We're looking at deals in those markets just because the competition's a little bit less. The appreciation is maybe not on par with what we're seeing in Texas, but the cash flow is just as good, if not better. And the competition is for those types of properties is not as intense as it is in Texas right now. Florida is a great market also, and we can still, we're looking at a couple of properties there where the numbers look like they make sense. So that might be an opportunity. But there's also other niches that we can also explore, and self-storage is definitely one. That's I wouldn't call it an overlooked market, but it's definitely not as intense right now as multifamily. There's just a ton of people looking at multifamily, and especially value add multifamily. So self-storage is definitely another niche that we might explore here in the near future.
Yeah, you nailed it right on the head. Multifamily is obviously the number one, right? Kind of the gold star that everyone is getting into. Really, obviously, the institutions getting into it are a huge factor for why asset prices are doing what they're doing, which makes these other asset classes, a little bit more appealing. So obviously, I'm a huge proponent of self-storage, kind of have been for a while. And it kind of, what's cool about it is it's different, right? It doesn't operate the same way. It's a little more hands-off if you want to, which allows you to extend your reach into other markets. Not quite as necessary to cultivate the same relationships. So what is it about these other markets that are kind of catching your eye? What are some of your indicators that you really look for when you're doing your market research?
So, so for us, really, right now, I'll use Florida as an example because there's some properties in Florida, there's some locations in Florida that I think are kind of like untapped, submarkets. So, for me, the Panhandle, Tallahassee, Jacksonville, those are markets right now for multifamily anyway that are a little bit of have untapped potential. There's tons of people looking in Orlando, tons of people looking in Miami, the Tampa area, but Tallahassee and Jacksonville have been a little bit of a untapped market. So there's properties in there that we're analyzing and doing some underwriting on that, they make sense. So we're in kind of in early stages of doing, underwriting and some due diligence. We'll see where that leads. But right now that's the biggest difference. I just underwrote a property here in Texas, just north of Dallas, with a sub 3 cap rate. Just there's nothing that we can't do anything with that. It doesn't fit our profile, and obviously it won't fit our investors' profile.
Absolutely, yeah. I mean that's a bit frightening, as I said before, sub 3. So do you guys do in-house underwriting? Kind of talk about your partnership and growing the business and that process for you guys.
So, I mentioned earlier the importance of having relationships, and over the last couple of years, I've been fortunate to join a couple of masterminds where I met several like-minded people. So we've partnered on a couple of deals, and we have people that have different strengths. So, I have a finance background, so for me, I don't mind, diving into spreadsheets and doing underwriting and analysis. I also do some capital raising, and then with my experience, I also help with the asset management. And there's other people on our team now that are very good at underwriting. Some only do capital raising because they don't do the analysis. They'll look at it, they understand it, but they don't want to spend the hours, in a spreadsheet and doing the detailed work. So I guess to answer your question, yeah, we do it in-house. Typically, one of us will take a lead depending on who has the lead on a property, and then we'll share the underwriting. We'll have at least 3 people look at it to kind of poke holes in it. We all have different biases when we do an analysis. Some of us are more conservative, some of us are a little more aggressive. And if we have at least 3 people look at it, we kind of land, I think, in a good spot once we complete the initial underwriting. It's important to point out, though, that when you do an underwriting, it is kind of a point in time analysis, and that analysis will continue to change, as you go through your due diligence and find out different things about the property and move forward. So, yeah, but that's, for us, the initial pass is normally, something that we do as a team. At least 3 people will look at it.
And what are some key metrics in your underwriting that you guys, kind of are like firm on, that you're not going to waver in terms of, like a checklist or strategy?
Well, for us, initially, the underwriting, basically all it is you're reading the income statement from the property, and you're using that to, extrapolate, 4 or 5 years into the future. So with that in mind, we understand that once you start making predictions about the future, that becomes very, very shaky. It's very hard to make those kinds of predictions. And a lot of times you're factoring in what you think is a best case scenario in the analysis. So for us, year one is kind of the big thing. We want to really see, like, what does year one look like? What does it look like right now? Is it stabilized? What's the vacancy like? What's the economic vacancy like? Will we be able to provide our investors a cash flow from the very start, or is this a property that may take a year, 8 to 12 months to stabilize and provide cash flow? So those are some of the things that we look at right off the top of the analysis. Is where is this property at today? Because I think that's where you're most accurate. You can most accurately see where it's at today, and it gives you a better picture of the property, and you can start to develop a business plan. So we know this property is in need of renovations. Maybe it was improperly managed, inefficiencies. But that I think for us is important, because you can look at that and that from day one from your analysis. Once you start making predictions about what might happen in the future and how you might be able to grow rent, how you might be able to cut expenses, those are all great scenarios, but you don't ever know for sure, right? I mean, it just kind of becomes a little bit of a prediction at that point.
Yeah, absolutely. And that's why it's important, at least in my opinion, to be, conservative in some of those predictions, right? Obviously, you're in Texas. Some of those markets have enjoyed some very nice rent growth, over the last 3-5 years, but it's important not to get too aggressive for the next 5 years.
Yeah. And one of the things that we've done is we are very conservative with our rent growth. Typically we'll use rent growth between 3 and 5%, which is really well below what we've seen to be organic rent growth here in Texas. Even before, even before this year, where we saw double-digit rent growth. Traditionally rent growth was probably in the 4% range. So we're basically using just an organic number in terms of rent growth when we do our underwriting, which is extremely conservative. So the fact that we've been able to do a couple of deals with that conservative of a number is really good. I mean, we're probably well ahead of our projections at this point.
Yeah, I don't know if anyone's ever really hit their pro forma. I feel like you're either under it or below it.
Yeah.
Or I mean, under it or above it is what I meant to say.
Right.
Ideally, the latter.
Yeah, but you're right. It's always a after year one, it's always it's anyone's guess, right? Anything can happen.
Absolutely. So what are some things, you know, obviously once you acquire the property, that's when really the work begins and you got to implement this business plan. So on the asset management side of things, what are some things you guys really look for in a property manager and, you know, really implementing that strategy?
Yeah, so I'm fortunate that one of our key partners has their own property management company. So we've used his property management company for the deals that we've acquired here in San Antonio. So in essence, it makes us in a way vertically integrated because we have that relationship with the property management company. You know, but the things that we look for is in the monthly reporting, you know, just the efficiencies, you know, the turnover numbers, the vacancy numbers, collected rents. You know, a lot of times you'll see a pretty good bump when you fire the previous property manager and bring in new management, because they're able to come in and really kind of clean up a lot of the inefficiencies from the previous manager. And we've seen, you know, people that have you know, tenants that have gone months without paying rent, you know, that they're not even bothering to try to collect or evict, and they can come in and clean up a lot of those types of problems. There's a lot of deferred maintenance that is an issue because, again, they haven't efficiently managed the property. So, you know, we have to come in and really focus on a lot of deferred maintenance type issues. Not huge problems, but you know, just, you know, small things that add up and take some time to kind of go through and fix. So, you know, those are the things that we look for in our property manager to make sure that they can come in and add value through those activities.
Awesome. I love that. That's so huge. You know, especially because obviously there's a difference between occupancy and economic occupancy. Is there a range in that sense that you guys, you know, are like, oh, wow, there's a lot of potential here. You know, when you're underwriting, let's say they're, you know, 80% occupied, but economic is like 55, you know, what are some things in there that you guys are looking at to, you know, boost all of that?
You know, I think it's a reflection on the market that we're in right now, the real estate market, especially in Texas. And you know, we're looking at properties that are what we would call value add. So we still think they're operating inefficiently. We still think that they have room to grow market rents, but they're 100% occupied, and it's incredible. You know, the fact that real estate prices for residential homes right now in Texas are it's such a hot market. You know, homes are on the market for a day or two and then are sold. You know, it's just driving rental demand through the roof. So we're seeing deals that are 95% or more, you know, occupied from day one.
Wow.
So it makes it, you know, from that perspective, you know, that checks off one box. I mean, it's fairly, you know, you look at a deal like that, that's fairly stabilized. But then when you look at their income statements and their rent rolls, you see, well, yeah, there's inefficiencies. They may be 95% occupied, but you know, they were offering, you know, tons of concessions on their leases. So, you know, that the loss to lease numbers is large, and you know, that leads to higher economic vacancy. So that's where you find the value, because you see that there's potential to improve those numbers and improve your overall, you know, net income that your property is producing. So from an pure occupancy standpoint, you know, we're seeing, you know, 95% or more in terms of vacancy rates here in Texas. But there are opportunities with economic vacancy, to your point, where we might see a property that's inefficiently managed, and you might have economic vacancies, you know, that are, you know, 80-85%.
Yeah, makes perfect sense. So explain loss to lease for the listeners. That's kind of a term that I learned late, but kind of explain that.
Yeah, so I think the simplest way is to think about it is for many of us who have rented before, I rented before. When you go and you fill out an application, you want to live at a complex. Many times they'll have special, like your first month is rent free or something like that. So essentially that, say your rent is $1,000 at a complex and your first month is free. So essentially that $1,000 becomes a loss to lease, because that's a concession they made to you as a new tenant to get you to lease with them. So that's basically the simplest way I know of to explain, loss to lease. And if you have a manager that's inefficient or ineffective, maybe is a better term, ineffective, you'll see a large loss to lease number, because they're having to do a lot of specials. They're having to reduce leases or lease amounts and give concessions back to tenants to get them to come in. And it could be because their property is mismanaged. They've kind of let the grounds go. It's not as desirable of a place to live. So that's when you see that high loss to lease number.
That was a great explanation. I appreciate that. And on that point, especially, like the outside, the aesthetics and things like that, do you ever drive around, see some of those kind of inefficiencies and try to contact sellers? Is that something you're doing as well?
I have not done that personally, not intentionally. Now I've been out driving around and I might see something and I'm like, wow, look at that property. And I might try to do a little bit of sleuthing around and trying to find out who an owner might be. But I'm not quite there yet. So I'm still a W-2 employee. So I have that commitment that I need to take care of. So I don't have the time or resources yet to get to that point. But I do have people I know who have done stuff like that and are willing to do stuff like that. So, that's another partnership that maybe might be coming down the road, that maybe there's a way that we can explore some sort of a partnership where if they are able to find a deal or bring a deal to us, they can earn a spot on the general partnership team.
I love that. And that's another great point for those who are new and want to get into it. I would say my top two, and this is very subjective, are being able to raise capital. To me, that's number one. If you can raise capital, you'll get a seat at pretty much every table. And if you can find deals and bring good deals, another really awesome way to get into this. So like he mentioned, he loved, if you're a finance person and you love spreadsheets, learn underwriting and, find good deals. And that's a great way to get your foot in the door. Yeah. So you mentioned that you're still W-2. What are kind of your goals to eventually get away from that?
That's a really good question, because, I hear a lot of people want to do real estate because they want financial freedom, they want to build wealth, and those are all great, great whys. My why is I would like to be able to make my W-2 job optional at some point. Doesn't mean that I want to retire. Doesn't mean that I want to quit. Just means that at some point I would like to be able to have the option to make that choice, right? So if anything were to happen to that W-2 job, I would know that I'm okay. So that's kind of my plan right now. And I think, that's my horizon is within the next 3 to 5 years. I would like to be at that point.
Awesome. I love that. And what is your W-2 job?
So I'm a business development executive for our local utility here in San Antonio.
Awesome. That's a solid job though. So it makes perfect sense.
Yeah, I get to do a lot of cool stuff with business models and finance and spreadsheets. So yeah, I enjoy it.
Hence the love for underwriting.
Exactly.
Awesome. Well, we're coming up on time here, but I do have 5 questions that I ask all of my guests. It's the final 5. So first question, what's the best advice you've gotten from a mentor?
The best advice I've got from a mentor was find a mentor sooner. And I say that tongue in cheek, but it really is true. I find mentors and coaches act as accelerators, and they really help you get to where you want to be faster. So if you know what you want to do, find a mentor, find someone who's where they are, where you want to be, and they can really accelerate your progress. So the sooner you can find one, the better.
I love that. So true. Best place to start is someone who's doing what you want to do. Reach out to them. What is it about your career that makes you feel like you're fulfilling your why? You kind of alluded to your why, but kind of talk about what part of this makes you feel like you're fulfilling it.
Yeah, so I'm pretty lucky. Working for the local utility as a business development executive, a lot of the programs and business models that we are working on benefit the San Antonio community directly. So I get a lot of pride from that work. And then investing in real estate, buying multifamily apartment buildings and then adding value to those buildings, we're bringing value to those residents. I think it's important for us as investors to never lose sight of the fact that, our residents are top of the list. They live in that property. They eat their dinners there. They celebrate holidays there. They raise their children there. So, we can't lose that sight of the fact that we are there to serve them as well and provide them with, a quality, living experience.
I love that. That's awesome. What's your favorite non-real estate or investment related book?
There's a book called Essentialism, and I can't remember the name of the author right now, but it's basically it's a book about how to prioritize your life, how to say no to certain things, create boundaries. And for me, it was very helpful in prioritizing, my life. Really, it's not just prioritizing business activities, but just life in general. How to say no to things that aren't important, and then really focus on what is important. What moves the needle for you.
Wow, I love that. That's I'm putting that on the list. That's a great recommendation. If you could have any superpower, what would it be?
That's a great question because I'm a huge Marvel guy. I love the Marvel movies. So
Nice.
I guess if I had any superpower, I kind of like Hulk because he was a combination of brain and bronze. He was super smart, Dr. Banner, and then super strong as the Hulk. So he had the best of both worlds.
I love that. That's awesome. Haven't gotten the Hulk yet. So the question actually used to be which Marvel character would you be, but not enough Marvel fans, unfortunately. So we went with superpower, but love a good Marvel reference. And the last one, what's the best way for people to get a hold of you and learn more?
Yeah, so I put together a lot of educational material. I have a white paper on why investing in multifamily makes sense. And you can find it all on my website. It's sastexascapital.com. And there's also sample deals on the website that you can look at and see kind of what we've done in the past. And that's a great way to connect and to get put onto our investor list.
Awesome. I love it. We will link that in the show notes. Simon, thank you so much for your time. This has been awesome.
Yeah, I appreciate it, Jonathan. Thank you very much.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.